Welcome to the Knakal News Network. Knakal News Network is brought to you by Massey Knakal Realty Services, New York's #1 building sales firm.
I'm John Hageman, Sales Team Manager from Massey Knakal Realty Services. Welcome to the Knakal News Network. Today I'm here with Bob Knakal, Chairman of Massey Knakal. We're here today to talk about the economy, interest rates, and how they're affecting the commercial real estate market. Bob, tell us about the economy today and how it's affecting the market.
The economy has been lackluster. I mean, really, since we came out of the Great Recession, GDP growth, for instance, has been averaging about 1.6%. Historically, GDP growth is in the 2.5% to 3% a year range. And considering the trillions of dollars that have been pumped into the economy, it's remarkable that GDP growth is as sluggish as it is. In fact, if economic output was at its trend rate, GDP would be about $2.4 trillion higher than it is today. To put that in perspective, that's about the entire GDP of Brazil or the United Kingdom. And that's how far behind we are based on the fact that the economy doesn't have traction in it today. If we wanted to get back to trend, we would need about 5 years of 5% GDP growth to get back to where we should be. That's a tall order.
Bob, it seems like in some ways the economy is getting better, but on the other hand, things still seem like they're struggling a little bit. Can you tell us where we are?
So some of the metrics aren't doing so well. If we look at real GDP per capita, it's below where it should be. Real median home prices are down. Industrial output, both from a durable and non-durable goods perspective, is very lackluster. And consumer spending and consumer confidence aren't where they should be. So these mixed signals are encouraging the Fed to continue with its easy money policy. That easy money policy, or quantitative easing as it's known, is keeping interest rates very, very low. And the commercial real estate industry is a beneficiary of that. The low rates really have driven activity. It's exerted tremendous upward pressure on property values. And we think that that will continue for the foreseeable future as these mixed signals continue to come out of the economy.
And how long, Bob, will these rates stay low?
Well, that's the big question on everybody's mind, is how long are the rates going to stay at these artificially low levels? A lot of that has to do with how the economy comes back. Rates will rise because of one of two things: either inflationary pressures based on the fact that the money supply has quadrupled, or the Fed's balance sheet has nearly quadrupled, will create inflation, which will drive rates up. That would be very bad for the real estate industry. However, if interest rates rise because there's tangible traction in the economy, that would be a very positive thing.
So, Bob, what do you really think it's going to take for our economy to get back on track?
I think we need rational and balanced policies coming out of Washington. We need to see some real leadership, which has been severely lacking for over a decade now. And I think that what we need to see is politicians to put politics aside and realize that we need a balanced approach. On the revenue side, our revenue as a percentage of GDP is very, very low, near historically low levels. And I think on the revenue side, it is important to raise taxes a little bit and look at a balanced tax policy as well. On the spending side, also our spending as a percentage of GDP is higher than it's ever been, which is really something that needs to be looked at. 30 years ago, only 20% of Americans were benefiting from transfer payments. Today, it's 49%. This is something that we really need to take a look at, and reforms, significant reforms in entitlements, have to be part of the equation. You know, and our debt and deficit problems are really tangible. Just 4 years ago, the average debt per household in the country was about $40,000. Today, it's approaching $100,000 per household. And the budget problems are very, very significant, but they've really been masked by these low interest rates that we have. So when interest rates rise, we're going to see the true damage that's been caused by these policies that haven't made any sense. In summary, the economy is very sluggish, with GDP growth limping along well below its 40-year trend of 2.5% to 3% growth. Economic metrics are uneven, causing the Fed to continue its easy money policy. What we need is a balanced approach to policymaking. Since Bill Clinton left office, we've had a lack of political leadership, which is sorely needed. Washington's failure to address this serious budget problem demonstrates their lack of acknowledging uncertainty caused by a lack of clear economic rules is negatively impacting the economy.
Thank you for joining us today. Tune in next week for another installment on the Knakal News Network.